This is your technical update from the LMAX Exchange Research and Analytics Desk for Tuesday, January 12th, 2016. At this point, with the euro consolidating, the market needs to be focused on 107 below and 110.60 above. It looks, following that latest breakdown below key support at 107.96, that the market should favor additional weakness below 107.11 and back towards the December base at 105.21. Only back above 110.60, which is now a potential lower top, would compromise this outlook and put the pressure back on the top side. Sterling dollar. So cable continues to be under pressure, with the market trading down to fresh 5.5-year lows, the lowest levels that we've seen since 2010. And although the market does look to be quite oversold at this point, and there is risk at some point over the coming sessions to see some form of a bounce before any meaningful bearish resumption. Look for any rallies to be very well capped towards 150, while ultimately only back above 152.40 would compromise the downtrend. Again, there is risk for a little bit more of a weakness, but additional setbacks should be limited given the oversold nature, with more risk for a more sizable correction before the market looks for a meaningful bearish resumption below recent lows that were seen on Monday at 144.94. Dollar yen. So dollar yen has been trading back down towards critical August lows just ahead of 116, and the market remains pressured to the downside. At this point, daily studies are looking a little bit stretched, so there should be limited downside beyond 116.12 before we see some form of a correction that could take us back towards 120. Ultimately, though, only back above 123.76 would take the immediate pressure off the downside in dollar yen. Euro Swiss. So Euro Swiss has been showing a contraction in volatility over the past several months, which could warn of a meaningful breakout in the days ahead. At this point, given the broader recovery structure, a push above 110.50, the high from September 2015, is favored for a move towards the 115 area further up. Only back below 107.15 would compromise the recovery outlook for Euro Swiss. Aussie dollar. So Aussie remains pressure to the downside, is now focused on a retest of the summer 2015 multi-year low just ahead of 69, with a break below to open the next major downside extension towards the 65 handle further down. At this point, though, we have seen some serious setbacks over the past several sessions, so there is risk for a bit of a consolidation or correction before the market heads lower. But any rally should be very well capped now below 72, while only back above 73.85 compromises the bearish outlook for Aussie dollar. Dollar CAD. So dollar CAD continues to press to fresh multi-year highs, a plus 12-year high for this market, now looking towards the next key figure at 143. But daily, weekly, and monthly studies are highly overbought at this point, so there is risk for limited upside before some form of a meaningful correction to the downside. A break back below recent lows that we saw around the 140.50 area would, however, be required to take the immediate pressure off the top side and open the door for that correction, potentially back down towards the 138 area. Kiwi dollar. So Kiwi has come under pressure in 2016 since stalling out ahead of 69, and the market is now focused on next key support, which comes in at 64.29, the low from the 18th of November in 2015. At this point, any rallies that we do see are classified as corrective and should be well capped ahead of the 67.50 area, while ultimately only back above 69 would compromise the bearish outlook for Kiwi dollar. SPX 500. So the S&P 500 continues with its declines as it shows signs of the formation of a major top and is now focused on a retest of next key support, which comes in at 1870 in the form of the 29th of September 2015 low. A break below there would then expose the extreme August low that was seen down towards the 1830 area. At this point, any rallies are classified as corrective and should be very well capped back towards 2000, while ultimately only back above the 2085 area would really compromise the newly adopted bearish outlook for the S&P 500. Gold. So gold remains well supported on declines and should be supported given the latest break that we saw above critical resistance at 1100. The break back above 1100 in recent trade suggests that we could be seeing a shift in the outlook, with a meaningful base now in place at 1046 in favor of fresh upside in the days ahead back towards some recent medium-term resistance around 1192, going back to the October of 2015.